Good evening, everyone. Come on in. Let's see who's in the house so I can give a shout out. Welcome, everybody. We are having a special edition of WealthyU Wind Down. I'm telling you, just the comments that I'm seeing and the conversations that I'm having lets me know that might be a little topsy-turvy in the stock market. How y'all doing? So tonight we're going to have a conversation about market volatility. We are going to have a review because I know most of my Wealthy You sisters have heard this conversation before, but for those of you who have not, we are broadcasting on YouTube and on Facebook. So for those of you who are not, then just know that we are here to share some insights. So let's see who's hanging with me this evening. Let's see. Hello. Concetta's in the house. Glad you could join us tonight. Our amazing facilitator, as well as welcome. Hey, I see my ambassadors in the house. Dr. Z is in the house. Joyce Valentine, good to see you. Yeah. For those of you, if it's your first time hanging out with us, just let me know in the chat who you are and where you're from so I can give you a shout out. Renata, I know you're not new to this, you're true to this, but hello to the great state of South Carolina. Welcome. Felicia Fort Rice is in Chicagoland. Awesome. Hello, Dennis Sample. Good to see you this evening. Lamerle, hello, hello, hello. And of course, Tawana is staffing me this evening, our amazing, amazing client success manager. So we're glad everybody is here. So yes, it is WealthyU Wind Down. That's right. It's WealthyU Wind Down. I'm Deborah Owens. I'm founder and CEO of WealthyU. And in this community, we're helping Black women build their investment portfolios to 7 figures and beyond. And what I'm really excited about is the fact that we did some WealthyU brags. How many of you checked that out in the community? And by the way, if you have not joined our WealthyU community, let's make sure you do that. Tawana, if we could just put my link tree, the link tree link in the chat so that you can learn everything that we're doing because we always have something going on in WealthyU, and it's all about educating, empowering, engaging, and most of all, execution, right? Mindset, strategy, execution. You know, I could not leave that out because, you know, you can have a whole lot of knowledge, but if you don't apply it, it means absolutely nothing. So welcome everybody. It is WealthyU Wind Down, where I always start out with a toast to all of you. I am drinking a fabulous wine that hubby got. It's a Cabernet Sauvignon. So let me toast all of you. This is pretty good. So if you have your favorite adult beverage, feel free to join in because we like to take the edge off. And I would say that right about now, the way this market is going up and down, we do want to take the edge out. But tonight, what I hope to do is really share with you some insight on how you need to be viewing this market, no matter if you're just starting out or if you've got significant assets, whether you're still employed or whether you're retired, right? So I want to kind of touch on that. But before I get started, Renata says, yes, take the edge off. I know that's right. But what questions do you have? I would love to hear what's on your mind. If we could take a look on our Facebook page and also allow some the comments so that I can see those as well. What is on your mind? What questions do you have for me about the stock market and the fact that we were down another 3%? I think that was on the Dow Jones Industrial Average. I know that the NASDAQ, which is tech heavy, so whether, you know, all of those ticker symbols, I'm going to give you guys a little lesson. All of those ticker symbols that are 4 or more are trading on the NASDAQ, right? If they're 3 or less, they're trading on the New York Stock Exchange or the American Stock Exchange. But, you know, we've seen Facebook, Amazon, and what's really, really interesting is how many of those companies as well just either split or announced a split. So I want to talk a little bit about that this evening. Go ahead, though. If you've got some questions, put them in the chat. But I think I'll just kind of set the stage for this evening. And maybe I'll ask you guys a question. How many of you feel like we could be going into a severe economic decline? In the chat, let me know. How many of you have that sentiment? Like, wow, you know, I go to the gas pump, man, you know, like regular is $4.49 and premium is at $5. right? Like 5 and some change, right? For those of you driving some of them highfalutin luxury automobiles that take, you can't drive regular, you can't put regular in it, you gotta put premium. How much did you pay at the pump? Right? So we're seeing that. Yes, 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 yes. Diesel 559. Wow, Dr. Z. Yes, it appears that way, right, Diane? Timmons says it appears that way. And Lamerle says you just have to hold on. And Jacqueline Megan says this is crazy, right? Yeah, diesel is high. I mean, I looked at a propane bill, and that is significant too for those of you who are in rural areas and you might use propane. That so anything that is energy related has went up in price. Would you agree with that? Okay. Now you go into the grocery store. So I gotta like kind of double click on that because the cost of everything is up, 30-40%. I was just looking at some blueberries. Blueberries, now when they got to $3.99, I was hollering. And I saw some blueberries that were $5.99. I was like, are y'all for real? Like, I'm trying to eat healthy and, and y'all gonna make it even more difficult. But yeah, so I'm making light of it. But you know what we don't realize, particularly in this country, is how good we have it. Right? How good we have it. That's all I want to say to y'all. Now, y'all might not think that way, but come on now. Like, if I think about my own parents who grew up on a farm and, 11 people in one little shack, we've come a long way, right? Many of you may be too young to have, to recall inflation of the 70s. Okay, like right now, where interest rates were at 15, 16, 17%. See, I need to put this in perspective. I got to give y'all some history. You know what I'm saying? Okay. So 70s, we had interest rates that inflation double digit. That was back in Jimmy Carter's days. And you at the time, can you guys recall that like a 9% mortgage, many of you may not, but a 9% mortgage at some point was like, man, that's a good deal, right? Then as interest rates came down, and it was like, I can remember in California, we had a 6% mortgage, and I thought, man, that was solid, right? 6%, what? Okay, then we've had, then we went to 5%, 4%. And if you guys will recall, the crash of 2008, the recession of 2008, unemployment was like at 8-9%. I mean, that wasn't that long ago, guys. That was like 12 years ago, 2008, 2009. And in fact, what happened after that recession, we're going to have a little history lesson here. We're going to walk back in time because it is important to understand, to look back at what has happened in the past so that we can have greater perspective on the future. Agree or disagree with me, you guys, right? So often we are just so focused on the right now, okay, that we cannot have a good perspective, and that's when emotion really comes in. Okay, now this is where I'm going. Okay, so I want you to understand is that from 2008 on, what our government has done is economic stimulus. And at every point, right? When the economy has stalled, what do they do? Economy stalls. In the chat. I'm not going to do all the work tonight. When the government wants to create economic stimulus, what does it do? Now, y'all, I know you know this. So in the chat, what does the government do? It's okay. Actually, that's right. Decreases interest rate. That's right, Cassandra, right? And why do they do that? Because it makes everything less expensive to buy. So you're going to start refinancing cars, you're going to start refinancing homes, and that kind of economic activity generates revenue for businesses, and it has it has a ripple effect, right? Because it's not just the banks that are going to profit off of that, that are going to generate fees. It's Home Depot, right? You refinance, you get your cash out, you're going to do a lot more to your home, you get a home equity loan, so that is economic stimulus and economic activity. And typically when they do that, they want to stimulate the economy. They make it easy for middle class folks to buy things, because they know that, middle class, you give them some money, you give them more money, you give them a refinance where they're going to pay less on their monthly payment, they're more than likely going to spend that. Okay, anybody agree or disagree with me on that, right? So I just want to give you, we doing like a macroeconomic level. I'm not going to get too deep on this, but if you look around you can make sense out of this. I love this term, make it make sense, right? So that's what we're doing tonight. We're going to make it make sense. Okay, so 2008, 2009, 2010, 2011, economy's kind of chugging along. We got Obama in. Things are looking pretty good, looking up. We had a few blips in there, 2014, 2015. Then fast forward, boom, COVID comes out of nowhere. Everybody's like, yeah, it's all right. Things are okay. COVID comes, nobody expects it. And what does the Fed do? They start not only do they start printing money, but here's the other thing is interest rates all this time. So we hit a blip in 2015, you want to stimulate the economy, you lower interest rates again. So now we're like at 4%. You're like, man, 4%, I better refinance this house. I better refinance these things, right? Then boom, then COVID hits. And, even before, the interest rates were pretty low, but then they're like economic stimulus, people aren't working, people are laid off. So what do? They start giving economic stimulus to businesses. We have our COVID relief plan. Where do you think all that money they gave all these businesses, whether it be the economic stimulus, some were grants, some were very, very low interest loans for long term that had terms that you don't pay for 4 or 5 years. They gave everybody in America pretty much about $1,200, right? And they did that a couple of times. Okay, so now you've printed all this money, interest. What are we going to -0? Can we do that? Where basically that would be printing more money, because now you're going to give people money and they don't even have to pay any interest on it. I just want you guys to understand this, okay? And so basically the chickens have come home to roost, right? Now the other thing, the stock market, let's talk about the stock market too. So at the same time all of this stuff is going on, we're at a high. Things are going along just well. COVID hits, and then you guys remember COVID? 30%. Boom! Same kind of feeling. How many of you feel like you're having deja vu right about now? Right? Like that's all I want you to got. I need you guys to remember what it felt like when the market fell 1,000 points and you were looking at your little 401k statement, your little investment accounts. You're like, oh my goodness, my money, I lost money. I had 100,000, now it's only 70. You guys remember that? In fact, in COVID, that's when we launched the WealthyU Society, and I was coming on every night having this conversation, giving some history lessons, right? So to the point, I'm not new to this. I'm true to this. When I started in this business, it was a stock market crash that everybody was running, their hair was on fire in the late 80s. And then 90, we had a recession. But my point is this, what I want all of you to understand is that on any given day, I want you to hear this. On any given day, economic circumstances can change, right? Just like we didn't see COVID come out of anywhere. And as an investor and as someone who wants to build generational wealth, you have to already assume and anticipate that that is going to happen. Okay, so first lesson that I want everyone in here to understand is this, is that the market is, it's about value, it's about companies making money, but at the heart of it, there is a whole psychological aspect to it. And this, what you're seeing, is the fear and greed index. And behind it, they use all kind of determinants to determine what is the emotional, the psychological condition of investors, right? So you see that a month ago it was neutral, right? That was just a month ago, even though we it's been pretty volatile. A week ago, boom, it was neutral because it was 46. I just want you to see the gauge, right? So this is a little gauge. 1 month ago, it was at 46, right? It was kind of neutral, like right there. Then a week ago, it was at 30, right? So it was right in the midst of fear. And now it's extreme fear. I don't know what it was today. Okay, so what I want you guys to understand is that the market is a market, right? The market is a market. And when you have more people buying, the market goes up. When you have more people feeling optimistic and thinking that companies are going to hit their targets and all of this, then people are like, boom, they're buying. But what is really driving the decline in the market are a number of things, and they're still pandemic related. China's Shanghai, I think they've been on lockdown for some time. And so in Asia, that's where a lot of the parts come, particularly around electronics. Apple's afraid that they're not going to be able to deliver on some of their hardware. You just saw a fallout from the company that makes the what are they, the electric parts for the engines, so you're seeing all of this ripple effect in the supply chain. And what that means is that when companies predict that they're going to have this they're going to be here, like they're doing perform a year from now. And as somebody who's been in sales, right, like at the end of the year, the fourth quarter, we come together, and first of all, we better make our numbers for that quarter. But now we got to think about what's going to happen in the future. So we project based on certain outcomes, based on our ability to sell certain units, and this is what companies are doing, right? That this is going to happen. So we tell the market, we tell all the analysts, yes, we think we're going to come in 20% ahead of what we did last year because we've got this. Yes, our supply chain is, we didn't have the goods now. Now things are loosening up. And then boom, you look up, you're like, oh man, we projected that we were going to do X, and now we know we're not going to have the parts. So we got to manage expectations. We got to say, hey, you know what? Second quarter, we might not make that target. I just want you you guys understand, because in Wealthy You, what you're doing. So one of the criteria for analyzing stock is what? Analyst. Did analyst surprise us? Did a company say they were going to be at X, but they didn't make it? So part of what's driving this market is the fact that the rosy picture that many of these companies painted is not happening. Okay. A lot of the companies were already selling way above what is normal. Now, I think we had this conversation about a month ago where I was saying, if that average annual return, I looked at somebody's fund and it was like 10-year average annual return was 22%. I think I told you guys this last week, and I was like, oh, that's like way out of the norm, right? Because average annual return historically on, let's just say, large company stocks, it's about 10%. Okay, so if you've got average annual return at 22%, then you know that stocks are overvalued and they're going to come back to the mean. Okay, now I know you guys are saying, man, I thought she was going to make it make sense. This sounds even worse, right? It sounds like it's getting worse and worse. I know that's not even a word, but so based on what I just described to you, because I want you guys to understand that I'm not going to get on this camera and say, oh, well, don't worry about it. Like, we just hit a decline and we got nowhere to go by up. I by no means am going to get on this live and tell you guys that, right? Why? Because, okay, let me ask you a question. Based on what I've just described, what do you think is going to happen over the next 3 to 6 months? Is the market going up or is it going down? In the chat, in the comments. Let me see if I can get on the comments here. Okay, so Tamika says up. Alice says nobody knows. And Dennis says down. Gail says down. Right. Okay. It will continue to fluctuate. Very good, Cassandra. More volatility, maybe down. Okay, Cassandra Books, Cassandra Boyd. Well, yeah. Yeah, I mean, if you just think about it, like there is, kind of like rocky road ahead. But here's what I want you to know is that you got to decide based on your situation how much risk you are willing to take. Okay, can you guys hear me now?
Barely, Deb, you sound distant. Mm-hmm.
Okay, I'm talking in the
Like your headphone is not on, or are you away from it?
Let's see. Okay, well, here's what we're gonna have to do. Second, let's see what happens. Okay, can you guys see me?
We can see you. We can hear you better.
Let's see. Can you hear me now?
Yes, just a little bit lower, but
Okay.
yes.
Thank God for iPhones. So you can hear me and you can see me, right?
Yes.
I don't know how much long this is gonna last. Is this all we can do now? Yeah. Okay. We have no idea what happened here, but okay. So where was I? So let me get my boundaries here. Okay, man, no, but I had some more things that I wanted to share with you guys. So here's what I'm going to say. You know, sometimes the tech gremlins appear, but so here's all I'm going to say is this: is that the key, right? The key to really succeeding, even when in this choppy market, is to understand what your risk tolerance is. Okay, now I had a chart that I was going to show you guys this evening that I typically share with folks who are in some of our training. And it's an asset allocation chart. And basically what it shows is worst case scenario. Because I think that's what you've got to be prepared. Like you need to understand if you've got like a portfolio that's 70%, 75% stocks and 25% bonds, you need to be prepared to see that investment go down by more than 40% in 1 year time, right? And we saw something similar to that in 2008, and we saw it in COVID. Now I said decline, I didn't say, and I want you guys to understand this, is that the only time you lose, right, is when you actually sell. Okay, so it's like one of the charts that I wanted to show you tonight, it shows that. So for example, when we were at our highest point with the market, it is that time when everybody's exuberant, you know, and then you hear, you know, just like the whole Bitcoin craze, and people were like, I'm a Bitcoin millionaire and I'm making $9,000. You aren't making anything until you lose. I mean, until you actually realize that gain. And so what's really critical is this. Here's what I want you to understand. If you got a portfolio and your 401k is 75% in stocks and 25% in bonds, then you need to be prepared to see the value of that decline by more than 40% in a 12-month period, right? Meaning, and sometimes it like it was in COVID where we were down like 35, 40% in a couple of weeks, and then we bounced back, right? Well, we didn't really bounce. It took some time, but we came back from that fairly rapidly. But sometimes it doesn't happen like that. Sometimes it's decline, 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 decline. And so here's what I want you guys to understand, is that actually particularly those of you who are investing monthly through your 401k plans. Maybe you've got a certain amount of money going into investments each month. One of the things that I really believe you should do is have an account for each of your goals and have money going into it each month being directed, right? And so if you're investing like that, what you're doing, and that's the point, another chart I was going to show you guys, is that you're dollar cost averaging, right? So as this market declines every month, you're going to be buying more shares at lower prices. And the way you win the investment game is not trying to time the market. The way you win is by acquiring and accumulating more assets. So your homework, so some homework that I want to give you tonight is I want you guys to go back and look at your statements from March of 2020 when we first started with COVID? Or was it 2020, right? March of 2020. And I want you to look at your statements, and I want you to look at April, May, June, July, and August. And I want you to see how you were accumulating more shares during those periods because the market was declining. And then I want you to look at how that impacted you as the market went up, right? So that's a little kind of short-term snapshot. But the other thing I want to say for those of you who are already retired, and so, it's like, you're like, I can't afford to see my money go down. And I would say this to anyone is that any money that you're going to need within the next 5 years should not have any market exposure, right? Like, we could go into a period where we're going to, we could go into a recession, and the worst thing that can happen is for you to have to sell those shares while the market is declining. And so for those of you who are already retired, can you come all the way out of the market? That would be nonsensical, right? Because you're going to need your money to last over time. But in order for you to have peace of mind, right? I got a question in the chat. Let me know. If you felt like the money that you were going to need was going to be available to you, would you feel more comfortable and it wasn't going to be impacted by the ups and downs of the stock market? Right? So that's number one. That's how you get peace of mind and you're able to stay the course and you're not fearful. And then lastly, the other thing that I want to say, and I'm going to leave you with this evening, is that one of the greatest lessons that I ever learned very early on in my career, and I think it bears repeating to all of you, and that is that the wealthy do the exact opposite of what most people do. And so you really have to understand that this emotional, like I showed you that fear and greed, the best opportunities arise when that fear index is at its highest. That is the greatest buying opportunity. But it's very difficult to understand that when you see all of your other investments going down. So here's what I'm going to leave you with tonight. And that is that you only lose if you sell. Right? You only lose if you sell. So I know we have a couple of questions in the chat. And let's see. Cassandra Brooks says, Warren Buffett said the same thing this morning. He said we should buy stocks that are down. Yes, that are down by 8% or more. But the most important thing you need to know, and you guys can do you guys know how to analyze, for those of you who are in WealthyU Society, you can actually go through those criteria and see which companies are actually hitting their targets and that are just down because of emotion and market sentiment. So, hey, if Warren Buffett said it, I know I'm onto something, right? Sharon says, I am retired and just spoke with my advisor, and he told me just stay the course. I will need my money in 5 years. There you go. I have lost 7%. So you haven't lost anything. Okay. Now I'm so glad you said that. Listen. You know, here's the example I like to use. Houses, right? Like, you know, we can look on Zillow and we can say, oh, my house is worth $1 gazillion, right? And then 6 months from now, that it's only worth $1 gazillion. And by the way, some of these home values, and typically the real estate market lags the stock market, right? And some of these home values that I'm seeing now because of demand are insane, right? Like are you guys having visions of like 2004, 2005, when, you know, people were just bidding up homes because there was such huge demand? And so what you need to do is be very, very strategic, right? You need to be very, very strategic. You need to think about what opportunities, right, are available to you that typically what's going to happen is they're going to be the opposite of what most people are doing. And Lynette says, yes, and they've got me upside down in their mortgages. Well, not really. No, they're not upside down in their mortgages now. Oh, you say in the future they may be, right? Because they're buying at such a high price. So, guys, I did want to come on and just give you some insight tonight. Was this helpful? Just about the market, what's happening, blah, blah, blah. I hope this was helpful. Excellent. All right. So a couple of things. Make sure you stay tuned because we are going to have an amazing event coming up, one of our quarterly events. It's get ready and tell your friends because it's going to be on June 4th, and we're going to be revealing a lot of the details. It's going to be a little different. Because this is going to be a working session. When you come out of this session, you're going to absolutely know. I'm going to double click on a lot of the things that I'm discussing tonight because I think it's very important. Because listen, if you're going to build a portfolio to 7 figures and beyond, you have to know strategery. Just kidding. Another one of my words, right? And so we're really going to be talking about what it's going to take to build your portfolio to 7 figures and beyond, irregardless. No, I'm going to stop using these funny words. Regardless of the ups and downs of the market. How's that sound, guys? Do you feel like, hey, you want to do a working session and come out of it having a blueprint, knowing exactly what you need to do to stay the course? All right. Stay tuned. If you haven't joined our WealthyU community, then you want to make sure that you do so. Tell your friends to join the WealthyU community. So right now, I want you on your calendar to save the date. It is June 4th from 10 o'clock to 2 o'clock. Yeah, we're still going to have fun. We're still going to have a DJ. Signed DJ is going to be there. But when you walk out of that session, you're going to have a really clear idea of what it means to invest regardless of the ups and downs of the market. And in fact, you're going to learn why it is in these downturns that you really, really have an opportunity. And so it's about developing the wealth mindset and knowing that you never lose. you either win or you learn. Okay, that's going to do it for me this evening. Make sure you bookmark it. You're going to be getting emails, and we're even going to have some contests for those of you who invite the most people. It's going to be lit. No, it's going to be fun. But again, thanks so much for everybody for coming on. I'm Deborah Owens, founder and CEO of WealthyU, where we're helping you build portfolios to 7 figures and beyond.